Hello, everyone, and welcome to Financial Accounting with Anne Marie Anderson. Today, we will be talking about the balance sheet, which is the third of the four financial statements. A balance sheet is a financial statement of net worth. It shows the company's assets, liabilities, and stockholders' equity at a specific moment in time. You might also hear it called the Statement of Financial Position or the Statement of Financial Condition. It's all the same statement. Let's look back to how we got here. First, we prepared the income statement, and next was a statement of retained earnings. Net income from the income statement carries over to become a component of the statement of retained earnings. This leads us to the third statement, the balance sheet, which takes the ending balance of retained earnings to become an element in the stockholders' equity section. Each statement builds off the one before, which is why we prepare them in this order. We head back to our donut business to look at the statement in more detail. The statement starts off the same way with the title of the company and the name of the statement, but the time period is different. The statement is presented with the balances on a specific day. This is kind of like your own bank account with the balance shifting from day to day. This is different from the income statement and statement of retained earnings, which show cumulative amounts. The balance sheet is where the accounting equation comes into play with assets equal liabilities plus stockholders' equity. An example I like to use for the accounting equation is a house. Let's say we have a $500,000 house as an asset. We signed a mortgage loan for $350,000, which is definitely a liability. That leaves us with $150,000, which is our equity or ownership in the house. The assets in your business either come from loans, liabilities, or from funds generated by the business or contributed by the owners. We can switch up the accounting equation to look at the data differently. For example, assets minus liabilities equals stockholders' equity. So if we have the house and subtract what we still owe on the house, that gives us our equity in the asset. Owner's equity is what's left over if we use all of our assets to pay off all of our liabilities. This is what's known as a classified balance sheet. We start with assets, which are split into two categories, current and long-term assets. Current or short-term assets are economic resources that are expected to be converted into cash or consumed within 1 year or operating cycle, whichever is longer. They are accounts like cash, accounts receivable, supplies, inventory, and prepaid expenses, to name a few. They are listed in order of decreasing liquidity, which means the most liquid items like cash are listed first. Long-term or fixed assets are also known as non-current and are expected to remain in use for longer than a year or operating cycle. These are items like buildings, equipment, computers, vehicles, land. The assets which are depreciated are shown on the balance sheet at net book value, which means the assets are netted against their accumulated depreciation accounts. Now we move on to liabilities, which are the obligations of the business. It could be money that is owed or services, but the business owes something. This category is also broken into current or short-term and long-term. Short-term liabilities are due within 1 year. This includes your basic accounts payable, accrued expenses, unearned revenue, and any short-term loans. Long-term liabilities are due beyond 1 year and include items like bonds payable, any long-term loans, or deferred taxes. This leads us to stockholders' equity, which represents the owner's interest in the business, as discussed earlier with the house example. Stockholders' equity is two pieces, paid-in capital and retained earnings. Paid-in capital is just what it sounds like, capital or assets that have been paid into the business by the owners. So when an owner puts assets into a business to get it started, the business gives stock in exchange, and that's reflected here along with paid-in capital in excess of par. Treasury stock is when a business buys back its own stock. Retained earnings comes directly from the statement of retained earnings and is the result of adding the net income of the period to existing retained earnings and subtracting any dividends. This graphic shows a side-by-side balance sheet. It illustrates the accounting equation and all of its components and summarizes nicely all the accounts we've talked about so far. The balance sheet shows us a company's financial position at a specific point in time, what it owns, assets, what it owes, liabilities, and what's left for owners, stockholders' equity. It helps assess financial stability, liquidity, and overall business health. Investors use the balance sheet to evaluate the company's net worth and financial strength. Managers use it to make decisions about financing, spending, and growth, and creditors use it to determine whether a company can repay its debts. That wraps up the balance sheet. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.